How liquid are agricultural investment funds for investors? Imagine planting a seed today and being able to harvest your money tomorrow. That's the kind of liquidity many investors hope for, but farmland investments tell a different story. Agricultural investment funds come in various forms, and their ability to turn assets into cash varies quite a bit. Most farmland investment funds are considered less liquid than stocks or bonds. That's because farmland itself is a long-term asset. Selling a piece of farmland usually takes months or even years. The process involves complex paperwork, appraisals, and finding the right buyer, which slows things down. When you own physical farmland directly or through a fund holding land, getting your money out quickly isn't easy. Traditional private farmland funds are a good example. These pools of capital buy large parcels of land and usually lock in investors for about 7 to 10 years. They rarely have secondary markets where you can sell your shares easily. If you want out early, you might have to wait until the fund matures or find a buyer willing to buy your stake at a discount. This makes liquidity quite limited and long-term commitment necessary. On the other hand, farmland real estate investment trusts, or REITs, trade on public exchanges. This means you can buy or sell shares daily, just like stocks. They offer much more flexibility, but their prices can fluctuate based on market conditions, which might not always match farmland's actual value. There are also agricultural exchange-traded funds, or ETFs, which invest in farmland-related assets. These funds are traded on stock markets, so you can quickly buy or sell shares. But because they often hold a mix of assets, including commodities and related securities, their value can be more volatile than directly owning land. Recently, online platforms have started offering fractional ownership of farmland. These platforms allow smaller investments and sometimes provide secondary markets. You might be able to sell your share within a year or two, but these options are still developing and may not be as liquid as stocks or ETFs. When considering farmland investments, think about your need for quick access to cash. If you plan to hold for the long term and want steady income and appreciation, low liquidity might not be a problem. But if you need flexibility, options like farmland REITs or ETFs could suit you better. Always check the fund's rules on redemptions, lock-up periods, and whether there's a secondary market. In summary, farmland investment funds tend to be less liquid because of the nature of physical land. However, newer structures and digital platforms are making it easier to access your money sooner. Still, they generally don't match the quick turnaround of stocks or bonds. Knowing your investment timeline and liquidity needs will help you choose the right fund for your goals.